Recent warnings from HM Revenue and Customs have brought to light an issue that could impact many pensioners across the United Kingdom, particularly those holding savings of £3,000 or more. This is not a trivial alert. It concerns the intricate relationship between personal savings and how they can unexpectedly affect entitlements to certain state benefits or tax reliefs. Many retirees believe their modest savings are safe and irrelevant when it comes to tax and benefit calculations, but the reality is far more complex, and understanding it could save you from unwelcome surprises. In the current financial landscape, as of the 25th of September 2025, HMRC is highlighting the importance of monitoring savings carefully because exceeding certain thresholds can influence eligibility for benefits like pension credit or the savings credit element, which, though phased out for newer claimants, still affects a considerable number of pensioners. Savings over £3,000 start to reduce the amount you can claim on these benefits by a specified rate. For every £500 above this threshold, your benefit entitlement could reduce by around £1 per week. Imagine having a nest egg of £10,000 and suddenly seeing your pension credit cut by up to £14 a week over the course of a year. This amounts to more than £700 lost, a significant sum for anyone living on a fixed income. Many pensioners do not realize that the government's assessments do not just look at money in bank accounts. Investments in ESAs, premium bonds, or certain types of savings products all count towards this total. For example, Mary, a retired schoolteacher from Manchester, discovered that her combined savings, which included a few £1,000s in an ISA and some premium bonds, pushed her just over the limit. She had been relying on pension credit to supplement her income, but faced a sharp reduction after HMRC's reassessment. Stories like hers are becoming increasingly common, making it essential for everyone with more than £3,000 saved to review their financial position carefully and consider how this might affect their benefits. This warning is particularly urgent now because of recent changes in the way HMRC and the Department for Work and Pensions are sharing data and cross-referencing savings and income details more rigorously than before. Advances in data matching mean that errors and omissions in benefit claims are being caught more swiftly. For those who fail to declare all their savings or misunderstand the rules, this can lead to repayments, penalties, or even legal action in severe cases. With the rising cost of living and the tightening of public finances, government departments are understandably more vigilant, making it crucial for pensioners to stay informed and proactive. It is also important to understand that this issue is not limited to new claimants. Even those who have been receiving pension credit or other means, tested benefits for years, should regularly check their savings and report any changes promptly. Savings that were once below the threshold may have grown over time due to interest, dividends, or gifts from family members, potentially affecting benefit calculations. Alan, a retired engineer from Bristol, found himself unexpectedly having to repay hundreds of pounds after inheriting a small sum from a relative, which pushed his savings over the limit. Situations like Alan's highlight the need to stay vigilant, keep thorough records, and, when necessary, seek professional advice. Another factor to consider is how the interplay between state benefits and private pensions could create unexpected consequences. Some pensioners assume that their private pension income or lump sums do not count towards their savings limits, but this is not always the case. While pension income is treated differently from savings, lump sums taken from pension pots can increase your total capital and may affect your benefit entitlements. This can be a tricky area, especially as more people take advantage of pension freedoms introduced in April 2015, which allow greater flexibility in accessing pension savings. If you are considering drawing down from your pension, it's worth pausing to understand how it might influence your eligibility for means-tested benefits. Furthermore, the tax implications around savings and pensions have shifted in recent years. The personal savings allowance and dividend allowance, introduced in recent budgets, mean you can earn a certain amount of interest or dividends tax-free, but these allowances do not affect the calculation for state benefits. This distinction is important because it means that even if you pay no tax on your savings interest, it can still be counted by HMRC and the Department for Work and Pensions when assessing your benefit eligibility. For many pensioners who rely heavily on interest income, this dual system can be confusing and lead to unintended consequences if they are not fully aware of how their finances are being evaluated. Considering the broader context, the UK government continues to face pressure to balance welfare spending with fiscal responsibility. The current administration has reiterated its commitment to supporting the elderly, but it also must ensure that benefits reach those who need them most. This has led to stricter enforcement and closer scrutiny of savings and income declarations. For pensioners, this means that maintaining transparency and staying updated on the rules is more crucial than ever. Ignorance is not a defense in these matters, and proactive engagement with HMRC or independent financial advisors can help avoid difficulties later. Practical steps can be taken to mitigate these issues. Regularly reviewing your savings, keeping detailed records, and consulting resources available from Citizens Advice or Age UK can provide guidance tailored to your situation. Some pensioners may find that restructuring their savings into different types of accounts or staggering withdrawals from pension pots can help manage the impact on benefits. However, these strategies require careful planning and should never be rushed without fully understanding the potential risks and rewards. Taking time now to get your affairs in order could prevent financial hardship in the future. It is also worth noting that the rules around savings and benefits can change with little notice, depending on government policy shifts or budget announcements. For example, previous years have seen adjustments to the savings thresholds, taper rates, and eligibility criteria for pension credit and other means-tested benefits. Staying connected with reliable news sources and updates from HMRC and the Department for Work and Pensions will ensure you are aware of any changes that may affect your situation. For many in the over 50 demographic, the challenge is not just managing finances, but navigating the increasing complexity of regulations and policies. Staying connected with reliable news sources and updates from HMRC and the Department for Work and Pensions will ensure you are aware of any changes that may affect your situation. For many in the over 50 demographic, the challenge is not just managing finances, but navigating the increasing complexity of regulations and policies. Digital tools and government portals have made it easier to track and update your financial information, but they also require a level of digital literacy that not all pensioners may have. If you feel overwhelmed, reaching out for help from family members or community organizations can make a big difference. In fact, some charities offer free financial health checks or advice sessions to help pensioners understand their options and obligations. This can be particularly helpful if you have a more complicated financial situation, such as multiple savings accounts, investments, or recently received an inheritance. Many pensioners underestimate how even small changes can have outsized effects on their finances. For example, earning a few £100s in interest above the personal savings allowance or receiving a modest gift from children or grandchildren could unexpectedly push you over the benefit threshold. In some cases, pensioners have found themselves needing to repay benefits they received in good faith, which can be distressing and financially damaging. Keeping a simple ledger of your savings and regularly updating it can be an effective way to avoid these pitfalls. It is important to highlight that while this warning applies to those with savings over £3,000, it should not discourage pensioners from saving or investing wisely. Having some financial security is essential, especially given the unpredictability of future costs like healthcare, home maintenance, or emergencies. Instead, it is about managing those savings intelligently, understanding the interaction with benefits, and making informed decisions. Speaking with a qualified financial advisor who understands the nuances of pensioner benefits and tax rules can be invaluable. Another aspect often overlooked is how couples' combined savings affect their benefits. For joint pension credit claims, the savings threshold and tapering apply to the combined savings of both partners. This means that a couple with individual savings just under the threshold may find their total well over it when combined, leading to reductions in benefits. Accurate reporting and joint financial planning become essential in these circumstances to ensure that no surprises arise. The changing economic environment, including inflationary pressures and rising energy costs, means that every pound counts more than ever for pensioners living on limited incomes. Losing even a small amount of benefit due to savings thresholds can impact daily living, from heating the home to affording essential groceries or medication. Therefore, this HMRC warning is not just about numbers on paper. It is about the real-life consequences for thousands of people across the UK. In summary, if you are a pensioner with savings of £3,000 or more, it is essential to review your financial circumstances carefully. Understand how your savings and income might affect your eligibility for benefits such as pension credit. Keep thorough records, report changes promptly, and seek expert advice if you are unsure. Staying informed about government rules and policy changes can prevent unpleasant surprises, protect your income, and ensure you receive the support you are entitled to. Sharing this knowledge with friends and family can also help build a community better prepared to navigate these challenges together. The complexity of the system might seem overwhelming, but taking it step by step can empower you to make the best decisions for your financial future. This HMRC warning is a crucial reminder that vigilance pays off. By staying informed and proactive, you can safeguard your savings, maximize your benefits, and maintain your financial independence well into retirement.